country doesn't collapse when tanks roll in. Sometimes it collapses when investors quietly walk out. No sirens, no headlines at first, just numbers moving on screens, and suddenly, an entire nation is in trouble. This matters right now because more countries today are deeply dependent on financial markets to survive. Not trade, not factories, markets. Governments borrow constantly to fund hospitals, schools, energy, even salaries. And they don't borrow from some abstract place called the economy. They borrow from investors. Pension funds, banks, asset managers, people who don't vote in that country, people who don't live there, but people who can decide its fate. Here's how the punishment actually works. When a government needs money, it sells bonds. A bond is a promise. Lend us money today. We'll pay you back later, with interest. As long as investors believe that promise, everything looks stable. Interest rates stay low. Money keeps flowing in. Life goes on. But the moment confidence cracks, the math turns brutal. Investors start asking quiet questions. Can this country really repay its debt? Is its currency safe? Is its politics stable enough? No announcement is made. They just demand higher interest or leave entirely. And that's when the punishment begins. Higher interest means every new loan costs more. Old debt becomes harder to roll over. Budgets get squeezed. Governments then face a choice with no good options. Raise taxes, cut spending, print money. Each option hurts someone. Markets don't care who it hurts. They only care about risk. As interest rates rise, currencies often fall. Imports become expensive. Inflation creeps in quietly. Then all at once, savings lose value. Wages lag behind prices. Public anger grows. Ironically, this is usually when politicians promise stability, right as markets decide there is none. Here's the uncomfortable part. Markets don't need to be right to be powerful. They just need to be consistent. If enough investors believe a country is risky, it becomes risky. Not because of ideology, because of math. This is why two countries with similar problems can experience wildly different outcomes. One keeps investor trust. The other loses it and spirals. Think of Greece after 2009, or Argentina, or Sri Lanka. The pattern repeats. The punishment isn't planned. There's no meeting where markets decide to discipline a nation, but incentives align. Selling early protects portfolios. Holding on looks irresponsible. So everyone rushes for the exit, rationally. From the outside, it looks like chaos. From inside financial systems, it looks like risk management. And here's the quiet irony. The same markets that reward countries during good times are the ones that demand austerity during bad times. Spend less. Cut deeper. Restore confidence. Confidence, of course, from the very people who left. Over the long term, this reshapes global power. Countries with reserve currencies get more room to breathe. Others live under constant surveillance by bond markets, rating agencies, and capital flows. Democracy still exists, but it operates within invisible financial boundaries. You can vote for change, but markets get a vote too, every day, and their vote moves trillions. So the next time you hear that a country is being punished by the markets, remember this: no force was used, no borders were crossed, no war was declared. Just confidence withdrawn, which raises an unsettling question. In a world where money moves faster than politics, who is really in control? Governments or the markets they depend on?